Live from Pimco HQ, good morning, from a beautiful Newport Beach, California. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from Newport Beach, coming up, Pimco unveiling its secular outlook. The CIO, Dan Iverson, just moments away, with CEO Manny Roman closing out the hour. On the U.S. economy and U.S. policy, Tiffany Wilding and Libby Cantrill. On the Federal Reserve, former Fed Vice Chair Rich Clarida. And on credit, Mark Kiesel with Sonali Peer. We begin with the big issue, the aftershock economy. Pimco's secular outlook indicating that markets will likely face more volatility as the global economy exits a period of massive fiscal and monetary support. What a fantastic way to kick off the next 60 minutes with the Pimco Chief Investment Officer, Dan Iverson. Good morning to you, Dan.
Good morning, Jonathan.
I can't believe it's been 4 years since we did this last time around. The last 4 years has been an absolute blur. Let's just start with the title of this new piece, and thank you for having us, of course. What is the aftershock economy?
Sure. What we're getting at here, and you suggested it in your opening comments, is that we've had massive disruption over the course of the last 4 years or so. Going into that period, we had record low interest rates. I think back in 2019, $18 trillion or so of negative yielding assets, a global pandemic, record stimulus, and inflation. And now over the course of the last 5 quarters, we've had about 500 basis points of central bank tightening. It's beginning to impact the economy. So when we look at the world and look at the types of shocks that we felt the last few years, we think there's going to be volatility ahead. We think we're at a unique time for markets now where there's been a tremendous amount of tightening injected into the system, and you're dealing with the period now where we expect to begin to see the economy slow, certain segments of the economy surprise to the downside. It's going to lead to ongoing volatility. We've experienced it in fixed income. We expect that volatility to work its way into equity markets. And it's going to create some challenges, but also opportunities for end investors.
Well, we'll talk about the opportunities in just a moment. Reading through the piece, fantastic essay, but something stands out for me. You've gone through the differences between now and maybe the pre-pandemic world, yet within the piece there is still a call for a return to target inflation at central banks, including the Federal Reserve here in the United States. There was also a call in there about going back to low real neutral interest rates. What's changed?
That's right. Now, we don't necessarily think we get back to the levels that we saw pre-COVID, but we do think real interest rates will normalize somewhere in that 0 to 1% range, perhaps a bit higher again than what we grew accustomed to for much of the last decade. And inflation, although we do expect in the base case for inflation to trend back down towards central bank targets, it too is likely to be much more volatile going forward. The balance of risks will be more symmetric going forward. So no longer do we live in a world where there's almost constant disinflationary pressure and a goal and desire from central banks to stimulate the economy to get back to target. So again, we are constructive in the sense that we take central banks seriously in terms of their desire to get inflation back towards target. We think eventually they will get inflation back down towards target. But over the next 5 or even 10 years, we're going to be in a very, very different world than the world we were in pre-COVID, where, again, these types of risks that were well contained for an extended period of time and led to a certain type of risk-seeking behavior by end investors is likely behind us. And we're going to be in a more uncertain world, a less synchronized world, and a world that's going to create, a tremendous amount of opportunity to take advantage of shifting opportunities across a global opportunity set.
Well, let's talk about those opportunities right now. Where are they for you?
Well, right now we are a bit cautious. As we mentioned earlier, there's about 500 basis points of stimulus that have occurred in record amounts of time. This is an economy where lags are likely longer than they have during prior cycles. The household, as an example, has been able to term out debt at record low levels, fixed rate debt. So they're feeling less of an impact from central bank policy. But trouble is ahead. There's been massive growth in certain segments of the market, private credit, senior secured loans, all of which float to the funds rate, so to speak, and are feeling the full brunt of tightening. So over the next couple of quarters, we do expect to see more signs of an economic slowdown. The good news, of course, is that we've had a massive repricing in fixed income. So we think today, in terms of putting together a portfolio, investors should focus on the public opportunity set, up in quality, and that could mean things like agency mortgage-backed securities that are trading at record-wide spreads. also some of the higher quality, more resilient areas of the credit opportunity set, we would be much more reluctant, and we are much more cautious moving into the more economically sensitive areas of the investment opportunity set right now. And that means underweights to loans, underweights to some of the weaker segments of the corporate credit markets.
This is a fixed income house, but within the piece this morning, there is a call on equities. You do make the point that you don't believe that equities have appropriately discounted the world that you're anticipating. What is it you see there?
That's correct. I think starting with volatility. There's been massive volatility in the fixed income markets. You look at implied volatilities in fixed income, they remain quite elevated. Equities have traded very well recently. The VIX index is down again in the 15 handle type range. So we do think that within the equity markets, there's a bit more complacency. We believe as we move forward in time, and this tightening in policy begins to impact the economy with a lag, you are going to begin to see some earnings pressure within the equity markets. You're going to continue to see, and this is going to occur almost in slow motion, continued pressure on corporate credit fundamentals. So as a starting point today, when we look at the fixed income markets, you look at the yields in the front end of the curve where you can put together a high quality portfolio yielding 6, 7, 8%, even slightly higher than that. We think that's a very, very attractive relative return. More cash flow certainty, more predictability. Even historically, that's a very, very attractive return. We think equities at these starting valuations are likely to struggle as we see more signs of an economic slowdown. And I think at that point in time, fixed income not only can provide an attractive yield, but also some price appreciation potential as well.
Within equity markets, there is a big hope and a prayer on AI. And the productivity story around AI perhaps runs counter and against your base case, your central case and a secular outlook, that we could end up with this massive productivity boom. Do you think maybe this, and I'll phrase this question in my way, and you can push back if you deem it appropriate, do you think there is a 150% rally in a single name right now that runs counter to your secular outlook?
Well, we are quite positive on AI as a technology. We've been spending a lot of time thinking about AI and already doing a lot of research in terms of how it can impact our business. And we're optimistic that there could be areas where AI could be quite enhancing from a productivity perspective. So there's certainly going to be winners in the stock market and losers associated with this new technology and the disruptive nature of this technology. Now, as a fixed income investor, disruption is not always a good thing. You better hope you are investing in credits that are not going to be disrupted by this technology. So, we acknowledge this in our research piece that this is a significant wild card.
Yep.
And if AI gets implemented in a manner that some think it may, this could lead to a sustained period of higher productivity. Of course, there's lots of other factors pushing productivity lower, and even productivity at the economy level isn't necessarily a great thing for financial markets, particularly fixed income, where at best you earn your coupon and you get par back at the end of the day. So the way we're thinking about AI is it's an important technology, it's a disruptive technology. We're assessing its impact from a macro perspective, but even more importantly, very focused on how it may disrupt the companies we invest in, the other business models we support across our business, where again, you better be sure that you're on the right side of the disruption. And again, one of the reasons we do believe that the next few years are going to be much more volatile, more credit losses than we've grown accustomed to, and just more within sector and across sector volatility associated with what we think, at a minimum is going to be highly disruptive. It very well could be the type of game-changing technology that does lead to more sustained higher productivity.
Can we
growth.
just go through the pockets of risk right now that you are de-risking around? Greg Peters of PGIM was on the programme with my colleague Lisa a little bit earlier this morning, and he talked about how some of the risk had moved away from high yield to loans and into private markets. Is that how you feel about where the risk is right now, and are you pulling back from those areas?
Yeah, we agree with that. It's quite remarkable. We were in a very, very low interest rate period for a long time. You end up with a COVID shock where rates hit new lows, and you had households, people with mortgages, significant portions of the investment grade and the high yield universe term their debt out at record low levels and buy themselves multiple years of cushion to deal with a weak economy. On the flip side, two of the fastest growing sectors since the GFC were senior secured loans and private credit. 100% floating rate markets, which made some sense when rates were low and anticipated to never go materially higher. That entire sector today is feeling the full brunt of central bank policy. Those companies are forced to pay higher and higher debt service coverage into what we expect to be a weakening economy. We don't think this is systemic, like the challenges in subprime back pre-GFC, But those are two sectors that are going to be challenged. They really haven't been challenged for a sustained period before. And we do think there's going to be disappointment there. There's going to be losses, the need to restructure debt. Stay away from those sectors today until they reprice. The other factor they have are very, very sticky marks relative to what you get in the public space. But we think this is going to be a phenomenal opportunity for new capital over the course of the next few years. So bottom line, stay defensive today, stay in the IG sector, stay in the high yield sector, but be poised to use some of that liquidity over the course of the next 5 years to take advantage of what are going to be significant challenges within that space. And again, this is moving at very, very slow motion because you don't see the price response like you see in segments of the public opportunity set.
Well, talk to me about what a cash allocation should look like in anticipation of that, and if you can throw it in there too. Are you thinking about a point on the calendar where you think this starts to bite? Because I feel like over the last 12 months, people have made this point and just keep pushing it out. It's going to happen, but maybe next year.
Yeah, so we've looked back at tightening cycles since 1950. And again, a wide range of outcomes during these different periods. But typically it's about 5 quarters before you see the impact from tightening on the broad economy. And we're right at that point today. Again, we've had record amounts of tightening over that 15-month range. So we would expect going into year end and perhaps throughout 2024, steady deterioration in some of these fundamentals. So today, from the cash allocation perspective, we love value in high quality bonds, particularly bonds priced off of the front of the yield curve. I mentioned earlier, you could stay in very, very liquid, high quality investments, generate 6-7%. Nothing wrong with cash here. I think it's good to make sure you're earning a full yield on your cash. But we think cash makes a lot of sense alongside high quality bonds. And that gives you the liquidity and the flexibility to shift into what will likely be a very, very attractive opportunity in private credit, in commercial real estate. We didn't talk much about that today, but that's another sector that's moving somewhat in slow motion, but where we expect there to be some challenges and therefore opportunities over the course of the next few years.
In the last 10 minutes, I've heard a lot about being at the front end, liquidity. I've heard a lot about risks on the horizon in the economy for earnings. I've heard very little about taking on more duration. Why am I not hearing that? Why isn't this the moment to buy a 10-year at 370 and anticipate this big Treasury market rally?
Well, it's not a bad idea. I think the good news, given the massive repricing in fixed income, is that you don't have to take a tremendous amount of interest rate risk in order to generate attractive returns. I think that may be a sense of nervousness in the market. Fixed income and duration in general have performed so poorly over the last few years. People are nervous. But the key point here is that, across Pimco mandates, we're operating near neutral duration across our strategies. In some strategies, even a little bit defensive or underweight, and still generating those yields I mentioned earlier, mid to high single digit type returns, while being able to be a bit insulated or a lot insulated from interest rate risk. So we don't dislike taking on duration here. We just think you can put together a high quality fixed income portfolio without needing to take a lot of interest rate risk. If we see rates a bit higher from here, if we see signs of further deterioration in the economy, we will look to extend those durations. Our durations are a lot longer today than where they were just a couple of years ago. So we're moving in that direction, but we still want to provide resilient portfolios. Inflation still remains elevated. Central banks continue to be active. So we think there, on the interest rate side, just be a little bit defensive as well. The markets have done the work for us. We finally have value back in the market. Sit back and earn your coupon and get a little bit of appreciation if we end up in a harder landing scenario.
Just a final one from me, Dan, because we've got a whole host of guests in front of us where we can talk about things like commercial real estate and credit. Mark Kiesel coming up a little bit later. What's your conviction trade right now? If you had like a number one conviction trade, what would it be?
Well, the most attractive asset on the board, at least within the public opportunity set, are agency mortgage-backed securities. They're trading as wide as they did during the COVID crisis. They're wide because interest rate volatility has been high. Everyone's concerned about the Fed selling them, the banks buying less. But you have a high-quality liquid asset trading at an incredibly attractive spread level. Again, a sector that we've been consistently adding across mandates. Not the most exciting trade in the world, but again, we're at a time where there's lots of uncertainty. It provides a steady income with prospects for significant spread tightening if the Fed begins to get closer to their terminal rate this cycle, and we begin to see volatility come down. So that would be our best opportunity within the public space.
Dan Iverson, the Pimco CIO. Let's not leave this 4 years. next time. I can't believe it's been 4 years. Dan, it's good to see you.
Thank you very much, Jonathan.
Looking forward to the next hour. The conversation continues. We get the view on the US economy and policy with Tiffany Wilding and Libby Cantrell. That conversation coming up shortly.
We think there's going to be volatility ahead. We think we're at a unique time for markets now where there's been a tremendous amount of tightening injected into the system, and you're dealing with the period now where we expect to begin to see the economy slow, certain segments of the economy surprise to the downside. It's going to lead to ongoing volatility. We've experienced it in fixed income. We expect that volatility to work its way into equity markets. And it's going to create some challenges, but also opportunities for end investors.
That was the Pimco CIO, Dan Iverson, just moments ago, discussing the company's new secular outlook, the aftershock economy. The team going on to write this morning, a new era of geopolitical tension between an established superpower and a rising rival will likely create global economic implications. Even absent a deepening military conflict, there is potential for a significant escalation of the US-China rivalry on other fronts. Been looking forward to this conversation for the last couple of days. The Pimco economist Tiffany Wilding joins us alongside the head of US public policy, Libby Cantrell. Fantastic to have you both with us. I think this is a theme that is going to impact your world, and it starts with your world, Libby. This was a key feature of the piece. I was surprised by that. We talk a lot about US-China relations, geopolitical tension, but I think the end investor often doesn't know what to do with it. What do you think is going to change in the 5 years to come?
Yeah, Jen, so we talked a lot about this at our secular forum. Actually, we were, I think, surprised by how many guests brought this up as sort of a prevailing theme for the next sort of 3 to 5 years. I mean, interestingly, what we're even seeing with our clients based here in the United States is that there's already a sort of a self-sanctioning in some ways of investing in China, or they're at least evaluating their allocations to China, whether existing or sort of future changes. So I think sort of from a secular perspective, difficult to know how obviously this is all going to play out in terms of increased tensions around Taiwan. But what we're already seeing with our client base now is just much more of an evaluation of their emerging markets allocation, whether they should, think about benchmark construction differently, maybe think about excluding China from the benchmark. So we're already seeing in some ways the secular theme playing out, today in terms of the cyclical.
It feels like very quickly this is becoming an inflation story. Tiffany, is that how you view it from your perspective?
Yeah, I mean, so I think any crisis accelerates trends that were already happening. So obviously we had the pandemic, we have the war in Ukraine, and that's just increased people's focus on supply chain resilience. And just we've called it reaching for resilience in the past. My esteemed colleague Rich, who's coming on later, will talk about the aftershocks. But certainly these trends have accelerated. And absolutely, reaching for resilience means not a focus on efficiency, and it also means higher costs. So I think over a secular horizon, average inflation above where we saw it at least pre-pandemic is a very reasonable scenario with probably more volatility around that.
Looking forward, I think this conversation shifts to the extremes really quickly, particularly around China. Military conflict, one, and you guys have pushed back against that and said that you don't need that. It could still be important and possibly important for the inflation outlook as well. But then you go to dollar reserve currency, you go to treasuries being sold, and everyone starts freaking out really quickly. Are you saying that I should be worried about the US dollar, the currency reserve status, Libby? Should I be worried about the treasury holdings over in China? This goes back to the investor conversation I was having to open this segment. What should I be worried about? Investors don't seem to know what to do with this.
Yeah, so in terms of the reserve currency, again, we talked a lot about this as well, and I think that the sort of the consensus, and which we would agree with, is that you can't replace something with nothing, right? And so you're kind of going back even to the Larry Summers quote in terms of, what are the alternatives? And I'll go even back to Bill Gross, our founder, when he talked about sort of the U.S. being the cleanest dirty shirt. And I think that was true as of 10 years ago.
It's true now?
It's true now. Now, in terms of sort of U.S.-China relationships, the U.S. policy outlook, I think, we talked about the 2024 election as well. That is in some ways irrespective of who's in the White House. What we're seeing play out in Washington, D.C. as it relates to China policy, we think the direction of travel here is clear. It is bipartisan. It will be sort of independent of who's in the White House. So sort of to your earlier question in terms of kind of our outlook, we think, regardless of what the sort of political landscape here is in the United States, this will be a prevailing kind of theme in terms of kind of Capitol Hill. But as it relates to the reserve currency, no, I think the consensus, generally in the marketplace, the consensus at Pimco is that the reserve currency is intact. Again, the U.S., that kind of the cleanest dirty shirt paradigm, if you will. Within the piece, you talk about potentially the end of fiscal activism coming out of the pandemic, but then I noted the trifecta of fiscal issues, policies that we've had over the last 12 months, 18 months. We've done a lot still. Tiffany, why is it necessarily going to be the end of fiscal activism in Washington, D.C. if we can all agree on this massive tension, if it's the one part where we have some bipartisan agreement in Washington, D.C., why can't we do more on this front? Well, I think, inflation is going to be a big constraint here. Obviously we have a lot of debt that's caused some consternation on the Hill, as Libby has talked about. But really, you're right, we have a lot in the pipeline, but I think moving forward, we shouldn't expect to see more. And I think this really matters over our cyclical horizon where we see a potential recession. And you're just not going to get the policy response that we've expected kind of in the recent past, certainly not the policy response like the pandemic, but also not like 2008. So from a broader macro implications point of view, that just means that, maybe we have a recession. We still think it's going to be shallow, but there's always the potential it's going to be deep. And you just don't get that policy response. So you accelerate back into something that's still below trend and still kind of sluggish. Yeah, so I was just going to add to that. I mean, we thought one of the sort of the biggest outcomes of the 2022 election was that this idea of sort of the fiscal put, Congress sort of providing some sort of floor to the economy, was withdrawn, sort of taken off the table under split government. And we think that sort of cyclical theme will actually prevail into the secular, and Rich will talk about this, just in terms of that kind of fiscal activism on both sides of the aisle, interestingly, right? Republicans are going to want to cut back spending, but Democrats, if they should take back power in 2024, they're going to really want to focus on the revenue side. So we think this is going to be a theme not only over the next 2 years, as Tiffany said, that there's no sort of more fiscal put in the short term, but also over the long term as well. Just quickly on the Inflation Reduction Act, I'm not sure about the title. I think a lot of people are not sure about the name of the bill. Do you think that's going to start to have a positive impact on growth, Tiffany, in the months to come, in the quarters to come? Yeah, I mean, so we do. I think that the bipartisan infrastructure bill actually has the potential to get money into the economy a little bit faster. The IRA and some of the energy credits and things like that, I think that is going to be a more secular story. And I do think that there is the potential for it to be bigger than what the CBO or other forecasters have estimated. But there's a lot of uncertainty around this, and a lot of this is dependent on energy prices. You really need these credits to incentivize green energy, and so the relative price of fossil fuels is going to matter here. So there's a lot of uncertainty around this. We think it builds over time. Yeah, it'll provide a little bit of support in the near term, but these are still nascent industries. These green energies, they need time to grow, to really impact broader macroeconomic outcomes. Libby, how are you thinking about that at the moment? Yeah, so we, just from what we hear from, companies that we're investing in, that permitting reform was really key in terms of the Inflation Reduction Act. So that's actually something that we just saw from a debt ceiling perspective, that, they deserve a down payment on energy permitting reform. I think our expectations for, really kind of this bipartisan comity to prevail are pretty low, but that is one area we could actually see from a policy perspective. So we've just heard this time and time again. For the IRA to really be effective, they need to have comprehensive both federal and state permitting reform. And we do think we got at least a first step, sort of a down payment on that in terms of the debt ceiling. A big feature of the overall conversation in the aftershock economy, I think, has been the post-pandemic labour market. I'm wondering whether that normalises. Given what we're talking about here, Tiffany, do we have the specialised knowledge to meet the moment, to meet these kind of initiatives in Washington? Yeah, I mean, I think there's the potential for some labor market disruption, not just with these issues, but obviously we have AI that we haven't even talked about yet. And that's going to create, not only is that going to change how people work, it's going to create a lot of new jobs that we probably haven't even imagined yet. And I think we're clearly on the precipice of that. I think near term, it's still, just from a cyclical perspective, we have industries that have underhired relative to where they were pre-pandemic. This is the government, for example.
example. This is education, this is healthcare, some of these service industries that are still having trouble getting workers. So that is going to be ultimately a near-term tailwind for the labor market. But it also means that wage inflation is still probably going to be sticky. And so, this is going to, obviously lead into cyclical discussions around the Federal Reserve and how tight monetary policy has to be.
This is going to be a big conversation for us coming up shortly. Tiffany, Libby, good to see you both.
Thanks,
Thank you.
Appreciate it.
You mentioned the former Fed Vice Chair, Richard Clarida. He joins us next on this program. Your opening bell just around the corner. Live from Newport Beach, California. Good morning. Good morning. I'm Jonathan Ferro. Going into the opening bell, equity markets shaping up as follows on the S&P 500. Futures just a little bit softer. No drama here. Slightly negative. We're down by not even 0.2%. We're negative 0.11% on the S&P. On the Nasdaq, negative about 0.2% as well. There's the opening bell. Switch up the board and get to the bond market. Some interesting moves there. Yields at the front end around 450 on a 10-year, about 370. Yields higher by a single basis point. In the FX market, getting used to life, below 107 on the euro, 106.80, negative by about 0.3%. All of this going into the Fed's next big meeting. Of the Fed, of course, going silent with its two-day policy meeting kicking off in just 1 week. Here's Pimco CIO Dan Iverson earlier this hour.
Although we do expect in the base case for inflation to trend back down towards central bank targets, it too is likely to be much more volatile going forward. The balance of risks will be more symmetric going forward. So no longer do we live in a world where there's almost constant disinflationary pressure and a goal and desire from central banks to stimulate the economy to get back to target.
Pimco weighing in on the Fed's road ahead, writing in their secular outlook, quote, "We don't expect developed market central banks to formally change their targets, but do expect those targeting 2% to be willing to tolerate 2-point-something inflation as part of what Pimco is calling an opportunistic disinflation strategy." I'm pleased to say that joining us now is the Pimco Global Economic Advisor, former Fed Vice Chair, good friend of ours, Richard Clarida. Good morning, Rich.
Great to be here, and thanks for coming out.
Good to see you. Thanks for having us.
Yeah.
Let's start with that. What on earth is opportunistic disinflation strategy? What is that?
Well, in some ways, John, it's back to the future. A lot of folks think of the early Greenspan years in the U.S. as opportunistic disinflation, raise rates to get inflation close to target, and then basically wait for the next downturn to get it all the way to target. And we actually think it's implicit. If you look at the Fed's SEP projections, they don't have inflation getting down to 2% for several more years, and yet they have themselves even cutting rates next year. So we think implicitly not only the Fed but other central banks will go down that road.
So when Chairman Powell last year talked about pain, Rich, do we not need that much pain then? Do we just push out the timeline?
Well, I think there will have to be an adjustment in the labor market even to get to 2-point-something. You see, the challenge now, John, is inflation's running at 4-point-something. So I think that pain in the labor market that Chair Powell referred to at Jackson Hole is going to be part of it to get inflation down to 2-point-something. But the next leg may have to wait till the next downturn.
Well, let's talk about the next downturn.
Yeah.
Where on earth is it? We've been talking about this for ages now. When Chairman Powell delivered that speech last year, even when you were at the Fed, I was thinking unemployment here, how's it going to handle this tightening cycle? We're going from 0 to 5 and unemployment's still around 3.5.
Yeah.
We had Dan sit in your seat a little bit earlier and talk about the longer variable lags. He said potentially they're longer. Is that how you and the team are thinking about it now?
Well, yes. Remember, we actually had a sharp slowdown in growth last year. GDP growth downshifted from 6 to 1. And it will probably be in the 1s or even lower this year. So we've had the downshift in growth. Yes, John, the surprise is the U.S. labor market is very resilient. Typically, that slowdown in growth, you would see much more of a rise in unemployment. Our view continues to be that the lags will kick in. Labor market's typically a lagging indicator. But yes, it has been a surprise how resilient the labor market's been.
The Federal Reserve is talking about a skip, not a pause. How much effort goes into a shift in language like that?
Oh,
to not use the word pause and for everyone to coalesce around skip?
Well, a lot of effort, a lot of discussion among members of the so-called Troika, the chair, John Williams, and now Phil Jefferson. And then, of course, it's socialized in the broader committee. But suffice to say, there's a lot of wordsmithing that goes on behind the scenes.
The potential future, almost called him the future vice chair, but he is potentially going to be that. Governor Jefferson, talk to me about how pivotal that address from him was last week. How important was that?
It was important. First of all, it was an excellent speech, and really in Phil's voice. I've known Phil for 30 years. We were colleagues at Columbia. But it did something very important, which is that the chair had tried to put his stamp on communication at an event at the Fed two or 3 weeks ago. And then, as is often the case, there's a lot of chatter from different Reserve Bank presidents and governors. And so market pricing was really all over the map. Do they cut? Do they hike? Hike 3 times, cut 3 times. And so Governor Jefferson came out and gave a very focused speech illustrating that a skip, if the committee chooses to skip, will not indicate that they're done. But they do need to respect the lags and the additional tightening we're likely to get from banking dislocation. So it, in essence, reinforced the message that the chair had delivered weeks before, and I think that served a very useful purpose because it shows that that's what the chair is thinking going into the next meeting.
Do you think this is it, the peak of interest rates of the Fed? Is that the view for you and the team?
Well, is it the peak? I think that the data's been coming in a bit stronger, and if anything, even some of the more dovish members of the committee have sounded a bit hawkish. So we could get an additional hike or two in this cycle. I think it's a closer call than I would have thought several months ago. I will say, I still think that the reasoning that the chair put forward, which is that we've had this dislocation in banking, 2 of the biggest bank failures in U.S. history. Right now markets have sort of moved on to the next thing, but some of those challenges remain. And so I think that's going to come back into the discussion at some point as well.
There were some thoughts about rate cuts. We priced them in. Yeah. We priced them out. Just how high is the bar for rate cuts?
John, I think the bar for rate cuts the rest of this calendar year is very high. Not only on economic grounds, but the communication's been very consistent from the most dovish to the most hawkish member. Every member of that committee has said, look, we're not going to do the heavy lifting to get rates in restrictive territory and then start to cut them. So I think the bar to cutting this year is very high because remember, the Fed has penciled into its projections a pretty sharp slowdown in the labor market. They have the unemployment rate going up to 4.5% by the end of the year without any cuts. So I do think if there are cuts, it's really a 2024 story. But yeah, I think the bar is high.
Let's pair this conversation with the secular outlook.
Yeah.
What are they going back to if they do begin to cut? There's been a big conversation about that. We're not going back to zero. I think we've both heard that conversation a million times. What would we go back to?
Well, we did a lot of discussion and thinking on this, and of course in 2014 we rolled out at our forum the new neutral idea, which was that the Fed funds range would end up neutral somewhere in 2 to 3%. And this year we reaffirmed that view. So we do think most of the factors that kept policy rates, again, these are the policy rates when you're at full employment and low inflation. We think there's more upside risk to the inflation outlook than the real rate outlook. And so our baseline view is that Jay Powell and Christine Lagarde and Andrew Bailey and the central bankers will do more or less what it takes to keep inflation expectations anchored. But if there is a risk to the inflation outlook, it's somewhat to the upside. So we do think that once the inflation rate has come down close to where the Fed wants it, once the economy's adjusted, we think, and apparently they still think through the dots, rates are getting down into the 2s.
You share that view?
I do share that view. I think what could be different this time, this saying this time is different. I think what could be different this time is we may have policy rates in the 2s, but we may have higher bond yields. The Treasury issued a lot of debt to support the fiscal policy during the pandemic. We now have a debt to GDP ratio back to where it was in World War II, 100% of GDP. It wasn't that long ago that folks like Ken Rogoff and others were saying once you get above 100, it fundamentally changes your economy. So we do think that the Fed will probably be doing less QE in the future, what we've called QE fatigue. And we think there's a limit to how much Treasury debt investors will hold without getting compensated. So we could see a world of steeper yield curves. Right now they're inverted, but they could re-steepen.
Okay, so basically the Federal Reserve is at 2, and you're thinking about what further out the yield curve?
10-year Treasuries ultimately somewhere in the 3s, depending upon how we get to 2, and also how credible the Fed is on inflation.
They're coming out with a ton of T-bill issuance at the Treasury, hundreds of billions.
Yeah.
Now, if you're a bear, you're bearish about it, and if you're a bull, you don't really care. Give us the reality check. What do you think that ultimately means? Hundreds of billions of dollars of T-bills coming into the market all at once. How does that spill over?
Well, it's interesting, John, because a lot of the discussion until recently has been there's been a shortage of T-bills. The Treasury's doing this, of course, because we got the debt ceiling bill finally passed, and they want to replenish their checking account at the Fed, what's called the Treasury General Account. So they'll do that by issuing T-bills. That will put some upward pressure on front-end rates. Not really an issue for the Fed in terms of maintaining its policy rate, but a potential issue for the liquidity of the banking system. Because when the Treasury issues T-bills to private investors, if private investors are not money market funds, those reserves drain the system. It could tighten liquidity in the banking system. If they come from money market funds, which are investing now at the Fed, it may not. So I think there's more than the usual amount of uncertainty about how bank liquidity evolves over the next 6 months with these T-bill sales.
Do you think that's another reason to skip June, to wait?
I do not think that's another reason to skip June. I think that if they skip June, which it looks like they will, it will be basically based on the macro and inflation discussion now.
I want to finish on inflation.
Yeah.
Just a final question.
Yeah.
In this piece, 2 point something. That's your world. I can hear your language in there. If we set a new inflation target today, not that they're going to, you push back against that, but if we did, would it still be 2%?
Well, the way I like to put it is that if you rewind the tape to 30 years ago and central banks had sort of agreed on 3, I don't think anything would be different now. But there is what people call path dependence in policy. And having committed to doing 2, I think it would be very costly. And I think they'll shy away from formally changing the target.
Interesting.
Yeah.
Rich, good to see you. Great to catch up as always.
John.
Fantastic. Richard Clarida there, the former Fed Vice Chair. Coming up, time to talk markets. We're speaking with Pimco's Mark Kiesel and Sonali Peer. That conversation just around the corner from a beautiful Newport Beach, California at Pimco's global headquarters. This is Bloomberg.
We actually had a sharp slowdown in growth last year. GDP growth downshifted from 6 to 1, and it will probably be in the 1s or even lower this year. So we've had the downshift in growth. Yes, John, the surprise is the U.S. labor market is very resilient. Typically, that slowdown in growth, you would see much more of a rise in unemployment. Our view continues to be that the lags will kick in. Labor market's typically a lagging indicator, but yes, it has been a surprise how resilient the labor market's been.
That was Pimco's global economic advisor and former Fed Vice Chair Richard Clarida on the labour market. Shifting to credit markets, Pimco writing in the secular outlook this morning, high-quality bonds may offer long-term equity-like return potential with significantly less volatility and more downside protection than equities. We believe fixed income markets are pricing in expected volatility in ways that equity markets are not. Pimco Global Credit CIO Mark Kiesel and multi-sector credit portfolio manager Sonali Peer join us now for more. Guys, great to catch up with you both. Sonali, I wanted to start with you and just talk about the maths of this, just the basic bond maths and why you guys believe that this year is going to be nothing like last year.
Yeah, certainly. The starting higher level of yields this year really provide a cushion. So even if we were to have some spread widening, we do see very high potential for positive returns. We've built in some lower price as well, so there's some downside cushion and some upside convexity in the bond market. Really, the bonds have almost never looked better, given the starting valuations.
Mark, I said this to Dan earlier this morning. It feels like you and the team are throwing cold water at equities this morning. Why is that?
Well, we think you can get equity-like returns in bonds. The long-term equity return over 50 years is 6 to 7%. We think we can get an equity return. We haven't seen this return potential in bonds in 14 years. When you look at nominal and real yields, high-quality bonds can deliver equity returns with half to third the volatility. So this is as exciting as we've seen it in almost 14 years, and we don't think these yields will be here a year from now.
Is there a maturity wall that I need to worry about?
Yeah, we're actually looking at markets where we had such robust open capital markets in the back half of 2020 and in 2021 that companies really termed out their debt. Looking at even high yield markets, we have less than 20% coming due over the next 3 years, which will mean that we have a lower default rate than in previous recessions, albeit higher from here.
2 sectors I think everyone wants to hear from you and the team on: banks, real estate. Can I start with residential? Mark, we've had this conversation before. Pre-crisis, pre-GFC, you called the top. Coming out of it, you called the bottom. Last year, you kind of almost called the top again. What's happening?
Well, I think, Jonathan, what's happening is that the consumer is sitting there with 3.5% unemployment, and also you've underbuilt the housing market for a decade. What happened back in 2006 is we were oversupplied by 2 to 3 million units. And then basically what happened is no one built houses for a decade, and so we undersupplied the market by 3 to 4 million units. So the market's really being held up by very low supply. But on the demand side, these higher interest rates are going to affect people for new purchases. So the bottom line is that housing's been more resilient because of constrained supply.
Is that a story that you're de-risking around in anticipation of trouble ahead? Is that a focus for you?
What we're doing is we're focused on the sectors where we think there's going to be significant secular and cyclical growth. On the secular side, you have things like LNG and defense, where you've got long-term tailwinds. On the cyclical side, you've got this move from goods spending to services. There's still huge pent-up demand for travel and tourism, particularly on business travel. So things like airlines, hotels, gaming, we're very much invested in what we call fun. Fun is returning. People have been underinvested in fun, and so that's where Pimco's moved.
As some of this doesn't feel like fun, does it feel like fun to you?
You know, higher yields and more dispersion gives us a lot more opportunity to invest.
The banking sector hasn't been fun. One thing that I've heard repeatedly, and a lot of people have heard repeatedly on programs like this one, is I want to be up in quality. I want investment grade. And then I can show you a failed bank that was IG just a month before it failed. What's gone wrong in that sector? And what have you learned from what's developed over the last few months?
Yeah, I think it's very difficult for banks to know how long their deposit base is there, right? So in terms of understanding how much we've repriced in terms of interest rates, that steep repricing means that they needed to have managed the duration of it, right? So meaning the assets and the management liability aspect. That's been one issue, and then really deposits are the lifeline for banks. So in terms of, from here, how we evaluate banks is we continue to look at these things, what they're invested in, what their deposit base, how correlated it is, and look for opportunities really within that, right? Not all of these banks are in similar situations, and in fact, I would very clearly make this distinction that this is not the great financial crisis. This is more of an issue of, the broader takeaway is the tightening financial conditions as opposed to the few banks that have been in a very difficult situation.
We know the regionals as a whole have a big role to play in commercial real estate, so let's tie together two themes, real estate and the banks. Mark, it's one of those things that we hear so much about. In fact, it's the number one question that people will come up to me and ask me, what are people telling you about commercial real estate? And then you get these calm, cool heads that come on programs like this and say, there's nothing to worry about, there's nothing to see. Is there anything to worry about? Is there anything to see?
Well, I think, John, just like all markets, there's going to be winners and losers, and credit is tightening most for the commercial real estate sector. You're seeing that in the regional bank, equity performance, the commercial REITs, et cetera. So this is actually going to end up in opportunities down the road for our private credit business. So we're actually very excited about it. The issue is the public markets have marked to market very quickly, so you've seen significant underperformance in those areas. The private markets have yet to mark to market, so we actually see this as a longer-term opportunity for Pimco.
Don't you think the repricing that's yet to come in private markets is going to have some kind of negative spillover for what develops in public markets? The losses that people might have to absorb there?
Yeah, it will, and that's why when you look at where we have been focused, we've been focused on these sectors where you've got significant improvement in fundamentals in the years ahead. I can show you many sectors where even if we have a mild recession in the United States, credit fundamentals will improve independent of the U.S. business cycle.
Name one.
LNG. LNG is on long-term contracts, and that sector will look more healthy a year from now than it does today, even if we have a recession.
We'll be sitting here in a year from now, and we can talk about it. Mark Kiesel, Sonali Peer, to the two of you, thank you. Thank you very much. Coming up, the conversation will continue. We're going to round out this hour with the man himself, the boss, the CEO, Manny Roman. Another exclusive conversation you will only see here on Bloomberg TV.
over the next 5 or even 10 years, we're going to be in a very, very different world than the world we were in pre-COVID, where again, these types of risks that were well contained for an extended period of time and led to a certain type of risk-seeking behavior by end investors is likely behind us. We're going to be in a more uncertain world, a less synchronized world, and a world that's going to create, a tremendous amount of opportunity to take advantage of shifting opportunities.
Just a brilliant collection of conversations this morning through the hour from a beautiful Newport Beach, California. I'm Jonathan Ferro. Pimco publishing its secular outlook, The Aftershock Economy, writing, quote, "We see a window to step in as a senior lender in areas once occupied by regional banks, such as consumer lending, mortgage credit, and various forms of asset-based finance." I'm very pleased to say that we can have that conversation now with the man himself, the boss, Pimco CEO, Manny Roman. Manny, good morning to you. Thanks for having us.
Good morning, Jonathan. Nice to see you.
That quote feels like your kind of language. We're going to step in. My first thought when I read that was, why don't you just buy a bank? There's many banks on sale right now. Why don't you just buy a bank?
Well, I think there are going to be many assets to buy. And maybe the best way I have to describe it is banks are going to be tight for capital. And when they're tight for capital, they have two ways of solving the problem. They can either raise more capital or they can sell assets. And the most likely scenario is there will be assets to sell in area where we have a big footprint. Mortgages, commercial real estate, bonds, municipal bonds. Dan said that earlier today that he was very keen on mortgages. There'll be mortgages to sell, and we'll be there to step in and try to buy them.
Are you looking at buying a franchise to do that, or is that just something that happens organically?
This is something that we've built over the past 20 years, and there's good news and bad news when you have a tougher economic cycle. I think the better news is that the expected return goes up and there are significant block of assets to sell. It could be, for example, equipment loans. One of the bank who was very big in equipment loans is out of business. All of a sudden, there's going to be a lot for us to do.
I hear this from other people too. I hear Apollo say banks are going to step back, we're going to step back in. How competitive is this going to be? Can you give me some size and scope and how big the pie is going to be?
It is going to be competitive because the seller has a fiduciary duty, and there will be enough for some of us to do a lot and put money to work and be patient and wait for the right opportunity to do so. And I think the cycle is usually long, and so there's no rush to put money to work. There is a very disciplined and systematic way to look at the opportunity, and some will look better than the other. It may very well be that the single best asset turns out to be real estate where we have a big footprint, or it may very well be that it turns out to be commercial real estate and mortgages in this whole segment. And
commercial real estate is something you've brought up, and I've heard it from Dan. I spoke to Mark about it just moments ago. Should I be worried about commercial real estate? Can you take me into the halls of this place, this building? Have you all sat around a table, gone through every single portfolio and thought about what you don't want exposure to right now related to this one particular sector?
Well, I think we have, and I think we've seen the playbook before, and it is everything else being equal, a slow cycle. So the banks will look at their portfolio and slowly but surely mark their books. I think you have a microstructure of the commercial real estate market, which is quite different, depending on the city, depending on the places. Some places are clearly tested. Some of them are doing just fine. I mean, you can look at Austin, for example. You're hard-pressed to find an empty office in Austin. And the overall trend is going to be that people somehow come back to work one way or the other. But there's a transition period where, for sure, there will be distressed seller and people who have the wrong financing. And I think the financing part is really, really important because it's one of the segments where we're very involved, and people have borrowed short-term in the past with very low rates. All of a sudden, the financing is expiring, spreads are higher, and of course, rates are much higher, and so they will need to address the situation either by selling or by refunding at more attractive terms for us.
Clearly, this business is going to change compared to what it was several decades ago. We've had a multi-decade bond bull market. Most people assume that's now over based on the last 12 months. Can you tell me how this business will be different with that in mind? What you need to position for now versus what this firm was positioned for in the previous several decades?
Well, the very big change, and Dan mentioned this before, is generative AI and how technology can change our business. And think, for example, about the real estate market. we can hire 100 people to go from city to city and kind of look at every single lease or every single property, or we can use technology to give us a better grasp of where the alpha is and where we think the opportunity is. When we think about communication with client, we can invest significantly in generative AI and actually give a better risk report, better customized report to clients, and so on and so forth. And I think it's incredibly exciting. I see the work that we do with OpenAI and Microsoft as important as the birth of the internet. I mean, it is that.
You think it's that powerful?
It is that powerful, and it will change your job also.
Change your job too, potentially.
Yeah, no, of course. I mean, in a good way. I think it will make us more productive, and I think that's a really, really good thing.
Is that a challenge to your secular outlook?
I think on a super secular basis, everything else being equal, I think it means rates are lower. But it also, I think you should say that with a humongous amount of humble pie, in a sense that the dispersion of event is going to be very big. And we don't know what we don't know. And it's easy for me to make prediction about what will happen 10 years from now. Chances are that I'd be very wrong. But it is quite exciting. And we've tried to get everyone in Pimco to play with ChatGPT and familiarize themselves with what we think is a super powerful tool.
Some people are nervous about doing that. What have you learned?
We need to embrace technology. And the reality is it's a very competitive market. Every single day, I think Dan and I ask ourselves, why do we think we can generate higher return than passive? Why do we think we can generate better returns than our competitor? Every bit helps. Technology is one of them. And I think we need to embrace it and have the course to stay and keep on investing significantly over the business cycle. And that's a competitive edge and a barrier to entry, just like everything else.
Let's measure success, AUM. Over the last 10 years, and let's go back a decade, Pimco was at about $2 trillion AUM. Not too far away from the likes of BlackRock. BlackRock's AUM since then has more than doubled. The AUM here is steady, with some volatility, tons of volatility along the way, but it's basically unchanged in the last decade. What do you think that reflects?
It reflects the decision we made is that we try to be very focused and do one thing and do it very well. And I think we went through a period of time where maybe fixed income wasn't as attractive as it is right now. And we have the view that if we perform, if we significantly beat the passive benchmark, if we do better than our peers, they will come. And we don't measure our success by the amount of assets we have. We measure our success by the returns we give to our investors in what is a very competitive market. And so the real sin of asset manager is to try to be bigger for the sake of being bigger because of economy of scale. We don't do that.
It's not a goal, just to be clear.
It's not a goal.
It's not a goal at all.
We're here to perform with the money we've been entrusted, and if we do a good job, we'll be fine.
Well, let's talk about that good job. There have been a couple of difficulties. I want to talk about one specific name, which is Columbia Property Trust. What do I need to know about that? What happened? Can you just give me a better idea of what happened there?
Well, I think for obvious reasons, we don't specifically comment on names, but of course we have a big portfolio of assets across the globe, and when you have a recession, some are going to be doing less well, and we're going to work on trying to get the best possible outcome. And the reality of fund management is you have, at any point in time, things doing great and things doing less great, and we focus on the one doing less great and making sure we have the best possible outcome.
So is that just a reflection of being so big that you're across everything, or was that a canary in the coal mine on a certain issue at a certain time?
No, I think it's a reflection of us having a diverse portfolio, and I think you heard one of my competitor at Milken saying that very well, saying that when you have a big real estate portfolio, at any point in time, not everything is going to do great. And I think we're willing to do that as long as the net result for our investors is going to be the right one. And I think that's what matters.
One last issue that we need to discuss as well, and I understand that perhaps you can't offer a great degree of clarity and detail because of litigation issues, but you know what name's going to come up in conversation now, Credit Suisse. Now, I just wonder from your perspective, the future of the AT1 market, contingent convertibles, after the events of the last couple of months, as a firm, and if you don't want to talk directly about that institution, we don't have to, but as a firm, have you rethought about that particular class of securities?
Well, the banks, especially in Europe, have a big need to issue AT1 as a way to raise enough equity to pass the stress test. And so there needs to be clear rule of engagement from both the banks and the regulator. And you've seen in the recent months the Bank of England and the ECB being incredibly vocal about what they think the rules of the game are and what a well-functioning market has to offer to make it attractive for investors to participate. And if the rules of the game are attractive and the price is right, you'll see plenty of people coming into this market, and Pimco will be one of them. And if the rules of the games are biased or unclear or at the expense of investors, then maybe we'll decide to step out of it.
Do you think they're biased and unclear now?
Depends on the jurisdiction. We have welcomed the comments made by the ECB and the Bank of England.
Manny, it's good to see you.
It's good to see you,
Thanks
Jonathan.
for hosting us. I appreciate it. Thank you very much. We've got to do this again next year as well. Manny Roman there, the Pimco CEO. That does it from me and the team. Thank you guys for setting up a wonderful set and a fantastic hour here in Newport Beach, California. This was the countdown to the Open. I'll see you back in New York City tomorrow morning. We'll have the whole team together, Lisa, Tom and myself, getting the band back together in New York tomorrow morning. This was the countdown to the Open. This is Bloomberg.